This meeting does not arrive in a vacuum for markets and investors. For 2 years, the Federal Reserve has held policy in a tightening posture. Now traders sense the first bend in the rate cycle approaching. Turning points are always noisy. The December discussion is not only about one cut or no cut. It is about how the committee frames the road ahead from here. Does the Fed sound confident about disinflation or uneasy about hidden fragilities? Language will matter a lot. Markets already carry heavy expectations that cuts will arrive over the coming year. Positioning reflects that story in equities, bonds, and credit spreads today. When expectations sit this high, disappointment can be more dangerous than surprise easing. Late cycle optimism can flip. In this episode, we slow down and read the meeting as a cycle signal. Not a trading alert, but a way to understand where we stand. We ask what a split committee means for unemployment, inflation, and growth risks. The tone will tell us plenty. Every rate cycle traces a story about fear, confidence, and the cost of money. The last tightening phase began with inflation shocks and a scramble to restore credibility. Since then, policy has shifted from emergency hikes toward a long plateau of restrictive settings. Plateaus never last forever. The first cut in a cycle usually carries more psychological weight than mechanical effect. Borrowing conditions do not transform overnight, yet narratives can turn surprisingly quickly. Investors start asking whether the bank sees weakness that data still hide. Confidence becomes the main variable. Historical cycles show how damaging misreads of this moment can become over time. Sometimes the Fed cut too slowly and inflation stayed sticky far longer than hoped. Sometimes it cut faster and later discovered that growth was already weakening sharply. Timing is always imperfect. The present cycle carries echoes of both paths yet remains unique in shape. We have disinflation without a classic unemployment surge, and that puzzles many observers. Output has slowed but not collapsed, and financial conditions remain tighter than past recoveries. The signals do not align neatly. Entering December, the committee has to decide whether to mark a formal transition. Holding rates again would signal patience yet also risk appearing behind incoming data. Moving toward a first cut would admit that restrictive settings have likely done their work. Either choice speaks loudly. Markets care less about legal decisions and more about the path implied beyond today. A single cut with hawkish language can feel tighter than a pause with dovish guidance. Forward guidance therefore becomes the real instrument that shapes valuations across asset classes. Words move curves and currencies. Our task is to read this meeting primarily through that forward-looking lens today. Where does the committee place the new neutral zone between inflation risk and growth anxiety? How confident does it sound about steering a soft landing instead of a delayed recession? Those signals define the cycle narrative. Global conditions also interact with this cycle through trade demand and capital flows. Other central banks have started their own adjustments, and that shapes relative yield differentials. When foreign policy stances diverge, money often migrates toward whoever offers clarity and stability. The Fed knows it operates in that web. The labor market remains central because it links household confidence, wages, and future consumption strength. Recent readings show moderation in job creation without a dramatic spike in unemployment yet. For some officials, this pattern supports patience and a very gradual easing path ahead. The labor side still looks resilient. Others see a different picture when they integrate hours worked, quits rates, and small business hiring. Under the surface, demand for labor has cooled more than headline unemployment suggests today. They worry that a mild shock could push firms from cautious holding to active layoffs. This is where disagreement begins. Inflation adds another layer because the recent progress has been welcome but uneven. Goods prices cooled faster, while parts of services inflation remain sticky and frustrating. Some governors fear that cutting too early would reopen the door to new pressures. Others see room to move. When you combine these views, the committee effectively faces a distribution of risks, not a single forecast. Doves emphasize employment slack forming slowly and the danger of tightening into weakness. Hawks emphasize sticky components of inflation and the memory of past policy mistakes. Both sides hold valid concerns. That internal disagreement often surfaces through dot plots, speeches, and the language of the statement. A wider spread of projections can matter more than the median path itself. It tells us whether the center of gravity is firm or fragile right now. Fragmented dots signal a delicate balance. For investors, the key is not choosing a side within this debate today. The key is understanding how that debate shapes the range of possible paths. A committee torn between downside growth risks and upside inflation risks will move carefully. Caution slows the journey to neutral. This is why markets will parse not just the vote count, but every phrase around conditions. When officials describe growth as solid, they support a shallower easing trajectory next year. When they highlight accumulating headwinds, they open the door to faster adjustments if needed. Small words shift the probability distribution. Household surveys reveal another dimension because they capture anxiety not yet visible in statistics. Many respondents describe feeling behind, even when they remain employed and solvent today. Such sentiment can change spending patterns slowly, then suddenly, if headlines turn darker. The committee cannot ignore this mood. Bond markets often sense turning points before economists finish updating their formal projections. In recent months, the yield curve has stayed inverted, yet with less intensity. Longer maturities have crept higher than lower as investors debate growth durability. It reflects unresolved uncertainty ahead. A meeting with visible internal disagreement can amplify these swings because it challenges simple narratives. If some officials push for cuts and others resist, the curve struggles to find anchor. Short rates track the policy decision, while long rates track growth and inflation expectations. Divergent messages pull them apart. History offers several examples where divided committees sent mixed but important signals to markets. In some cases, dissenters warned about overheating risks that later materialized in inflation surprises. In others, they warned about fragile credit structures long before a downturn became obvious. Minority views can age very well. The lesson is not to hero worship dissenters, but to study their reasoning carefully. Each vote usually reflects a different weighting of the same incomplete data set. Watching how those weights change from meeting to meeting reveals evolving internal priorities. That evolution guides the medium-term path. For this December meeting, the presence of multiple dissents would underline a regime in transition, a narrow majority cutting, while a sizable minority prefers to hold signals lingering inflation worry. The opposite structure would highlight anxiety that restrictive policy is already biting growth too hard. Either way, markets will map those coalitions. Investors who study these splits gain more than traders reacting only to the headline rate. They see how close the committee stands to a tipping point in future decisions. They can build scenarios for growth, inflation, and asset pricing under each coalition path. Scenario thinking replaces binary bets. All these cross-currents mean volatility may stay elevated, even without extreme moves in fundamentals. When policy regimes shift, investors often reprice how they value duration, credit, and equity risk. Periods of adjustment tend to reward patience, diversification, and clarity about time horizon. Chasing every swing rarely helps. It is tempting to treat every FOMC meeting as a verdict on the economy. In reality, each meeting is more like a chapter in a longer unfolding narrative. December may feel dramatic, yet it will only define the next stretch of the path. Perspective becomes a risk management tool. If you follow macro from a distance, your edge rarely comes from speed alone. It comes from understanding where we stand in the cycle and what matters most. Right now, the key question is how the Fed balances inflation scars with growth uncertainty. That balance will evolve over time. Listening calmly to this meeting means paying attention to words, probabilities, and internal tensions. Then you relate them to your own horizon, rather than chasing every intraday swing. Policy will keep shifting as new data arrive, and as risks change shape. Your framework should stay more stable. In the end, reading the Fed is less about predicting decisions and more about mapping regimes. December sits near the border between a tightening era and a gentler but uncertain phase. How you interpret that border will shape how you see risk across the next year. Cycles change, yet discipline remains essential.